Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know, first, China imposes tit-for-tat port fees on US ships, a symmetric escalation leveraging its 53.3% shipbuilding dominance over America's 0.1% share. So we'll discuss why this new symmetric strategy creates a dangerous escalation cycle and what it means for shipping, profits, and trade rerouting. Second day, $770 billion tech sell-off erupts as a 100% China tariff threat sends the Nasdaq plunging 3.6%, its worst day since April. We'll examine how extreme tech concentration amplified this shock into a systemic risk and what it means for the AI boom and the Fed's inflation fight. Third, Bitcoin's surge creates 70,000 new millionaires, fueling a $145 billion consumption boom that complicates the Federal Reserve's inflation fight. We'll explore how this crypto wealth effect is spilling into the real estate market and why a potential change in mortgage rules could reshape US credit. The trade war just took a surprisingly direct turn. China has announced it will start charging US ships for docking at its ports, a move that directly mirrors a fee Washington just slapped on Chinese vessels. Starting October 14, Beijing will charge 400 yuan, or about $56 per net ton on American ships. That is the exact same dollar amount the US is imposing. And it doesn't stop there. China is even matching the US plan to increase those fees on the same schedule all the way through April 2028. This is a direct tit-for-tat retaliation. But this move actually signals a tactical shift in strategy. In the past, China often responded with asymmetric measures like restricting exports of critical materials. This move is symmetric, a direct mirror image response. This is where the situation takes a more complex turn. While this more predictable pattern might reduce immediate market panic around any single action, it also raises the risk of locking both sides into a cycle of escalation that becomes increasingly difficult to break without one side losing face. The Chinese Ministry of Transport said the American fees seriously violate international trading principles. One analyst is calling this a major miscalculation. Peter Alexander of ZBen Advisors in Shanghai said, quote, "The Trump administration continues to underestimate China, and this needs to stop." He added, "China can give as good as it gets and has demonstrated a willingness to take direct action." And a single statistic really puts this entire conflict into perspective. According to the Center for Strategic and International Studies, the US accounts for just 0.1% of global shipbuilding. China, a staggering 53.3%. This massive imbalance is the quiet leverage behind Beijing's move. So why is this imbalance such powerful leverage? The thing is, the US fees are unlikely to truly stimulate America's own shipbuilding industry. The core issue is cost. Due to long-standing regulations like the Jones Act, a US-built ship can cost up to 8 times more than a similar one built abroad. Research from the Cato Institute shows US shipyards require 40 to 60% more man-hours for the same work. This huge gap means tariffs alone can't close the competitive disadvantage, demonstrating the limits of using tariffs as an industrial policy tool in such a capital-intensive industry. This isn't an isolated incident. The port fee announcement comes just days after China expanded export restrictions and blacklisted the major chip consulting firm Tech Insights. The American Chamber of Commerce in China is already warning this will likely mean higher costs for US consumers and lower profits for shippers. Let's break down these two impacts, because the reality is a bit more complex. First, on lower profits for shippers, this is very likely. This fee structure is a direct hit to the profit margins of major shipping lines, especially since the rules target the beneficial ownership of the vessel, not just its flag. We should expect to see this pressure reflected in their upcoming quarterly earnings reports, making maritime logistics stocks a key sector to watch. But as for higher cost for US consumers, the story is different. The key insight here is not to expect an immediate jump in the price of goods. Why? Because the global shipping market currently has weak demand. To protect their market share, many shipping companies will likely absorb a large portion of these new costs themselves, rather than passing them all on to customers. Research from the Federal Reserve Bank of Boston confirms this, showing that this pass-through to consumer prices is often incomplete and slow. So any impact on inflation will be a lagging indicator, not an immediate shock. Despite a recent call between US President Donald Trump and Chinese President Xi Jinping, the escalation is a direct challenge, leaving Wall Street watching the next move in this high-stakes economic chess match. So, what should we be watching for next? The key here is to look beyond the direct US-China route. These new fees will almost certainly accelerate a trend that's already underway, the rerouting of trade. Shippers will increasingly try to avoid these direct fees by shifting routes through Southeast Asian hubs like the port of Haiphong in Vietnam or through Mexico's port of Manzanillo. In the near term, this could create new logistics bottlenecks. But for investors, it also points to new opportunities in the infrastructure and logistics companies in those alternative regions. This supply chain reconfiguration is the most important leading indicator to watch. As one analyst bluntly put it, have there been any lessons learned by the Americans over the past 6 months? It certainly doesn't seem so. Speaking of that high-stakes economic chess match, another major piece was just slammed onto the board, rattling the entire tech sector. $770 billion. That's how much market value was wiped from tech's biggest names after a single announcement sent shockwaves through the market. The trigger was a social media post from Donald Trump declaring the US would impose a 100% tariff on China. The post also threatened to apply export controls on, quote, any and all critical software starting November 1st. The real concern here goes beyond the tariff itself. A while back, we walked through how export controls can reach far beyond obvious military tech. A 100% tariff is an extreme measure, far beyond what was seen in the 2018 to 2019 trade war. But what's even more concerning for the market is the ambiguous term critical software. According to US Export Administration regulations, this isn't just about military applications. It can include a wide range of technologies, such as software with encryption capabilities or even intrusion software. The broad definition creates enormous uncertainty for companies, signaling a potential hard decoupling of the US and China tech supply chains, threatening the very digital services that connect the global economy. The market reaction was immediate and brutal. The Nasdaq plunged 3.6%, its worst trading day since April, bringing a sustained tech rally to a screeching halt. We previously analysed how markets were leaning heavily on a smooth easing path, and the latest development is a textbook asymmetric shock that forces a fast repricing. Why such a violent reaction? Well, a big part of the problem is that major stock market indices like the S&P 500 have become incredibly concentrated. The top 5 tech companies now constitute over 25% of the S&P 500's total market capitalization. As we've discussed before, that concentration means a shock to just one sector, in this case, tech, doesn't stay contained. It immediately drags the entire market down with it, challenging the traditional idea of a diversified portfolio. The fallout for individual giants was staggering. Nvidia, the AI chip kingpin that recently became the first company to hit a $4.5 trillion market cap, saw its value plummet by nearly $229 billion in one day. Microsoft, a critical cloud supplier for I saw its market cap drop by $85 billion. And Tesla, which just introduced lower price vehicles, watched $71 billion of its value evaporate. And here's where it gets really interesting. This hits at the very foundation of the recent AI boom. That entire rally was built on the assumption of massive, uninterrupted spending on AI infrastructure, things like data centers and servers by giants like Microsoft and Amazon. But this trade threat acts as a major negative catalyst. We were already seeing signs of a slowdown. For instance, recent quarterly reports showed that capital expenditure growth at both Microsoft and Amazon was decelerating, falling short of analyst expectations. This new uncertainty could cause these hyperscalers to pause their spending commitments, which would directly impact the earnings of companies like Nvidia. But that's not the whole picture. For Amazon, the pain was even more acute. The sell-off completely wiped out all of its gains for the year, erasing $121 billion from its valuation and leaving the stock down 2% for 2025. And this pain isn't likely to stay just on Wall Street. The key difference this time is that unlike the tariffs from a few years ago, which companies could partially absorb, a 100% tariff is simply too large to be absorbed. Research from the Federal Reserve and the IMF on the 2018 to 2019 period showed that tariffs were almost fully passed through to US importers and ultimately to consumers in the form of higher prices. A 100% tariff would almost certainly trigger a new rapid inflationary shock. A few days ago, we also noted that some Fed officials have tended to view tariff-driven price spikes as transient. A move of this magnitude paired with sweeping software controls could be the kind of shock that challenges that view. This wasn't just a bad day for a few stocks. It was a direct financial shockwave, demonstrating how a single political threat can instantly vaporize hundreds of billions of dollars built on AI optimism and global trade. The market is now fundamentally re-evaluating risk. For years, tech valuations were based on an assumption of frictionless long-term global growth. This event forces investors to price in a higher, perhaps permanent geopolitical risk premium. We previously warned that confidence in a steady path of rate cuts left markets vulnerable to a sharp repricing if the data or policy backdrop shifted. This is that repricing showing up in real time. So what's next? In the near term, we can expect continued market volatility. For Chinese-speaking audiences, this has direct implications. A hard decoupling could put depreciation pressure on the Chinese yuan, or RMB, as international demand for Chinese tech products falls. Domestically, if this inflationary shock materializes, it would severely complicate the Federal Reserve's job, possibly forcing them to maintain higher interest rates for longer, which would affect everything from bonds to housing prices. Continuing our last discussion about the Fed's data dependence, the focal points to watch now will be the monthly inflation data, like the CPI, and any further guidance from companies on their capital spending plans and supply chain strategies. And as we've discussed before, labour market prints like JOLTS and weekly jobless claims, plus the next PCE, especially supercore services, will be critical. One more reminder from a while back, if a government shutdown disrupts data again, policymakers could be flying blind just as these trade shocks hit. On policy, recall the hawkish counterpoint, we highlighted only one more cut if the data don't cooperate, which raises the risk of a policy rate divergence that markets have been underpricing. Disclaimer, this content is for informational purposes only and not investment advice. Market information is volatile and subject to change. While Wall Street is grappling with these geopolitical risks, a completely different financial force is quietly reshaping the economy, and it's also giving the Federal Reserve a major headache. Believe it or not, the latest Bitcoin surge just created 70,000 new millionaires in the past year alone. The total count now stands at over 241,000 individuals with crypto holdings worth $1 million or more. Among them are 450 centimillionaires holding over $100 million each, and even 36 crypto billionaires. The total market cap for all cryptocurrencies has swelled to over $4.3 trillion. But the real story is how this new wave of wealth is reshaping the economy. A new study found these investors are contributing an estimated $145 billion to US consumption in 2024. For every dollar of crypto wealth they gain, they spend nearly 10 cents. That is more than double the spending rate of investors with gains in the stock market. What's really happening here is a phenomenon economists call the marginal propensity to consume, or MPC. It measures how much of each extra dollar of wealth people spend. A recent study using transaction-level data found the MPC from crypto wealth is more than twice that of stock market wealth. This is wild because it introduces a highly volatile new factor into economic forecasting. The Federal Reserve relies on consumer spending models to set policy, but the explosive growth and volatility of crypto wealth make predicting consumer behavior much harder. And if you're picturing a fleet of new Lamborghinis, you're missing the bigger picture. While some splurge, most of the consumption is on restaurants, entertainment, and general merchandise. The real long-term target is real estate. In fact, one study found that when Bitcoin spiked, home prices grew nearly 0.5% faster in counties with large crypto populations, and this represents a direct spillover from the digital world into the real economy. A sustained crypto bull market could create localized housing affordability crises in new tech and finance hubs. This is a major headache for the Federal Reserve because it's trying to cool down inflation, especially in housing. But this price pressure isn't coming from traditional bank loans. It's coming from a new source of wealth that is much harder to control with interest rates. However, if you zoom out, you'll see another layer of strategy at play among these new millionaires. Many of them are refusing to sell. According to Tad Smith, former CEO of Sotheby's, they want to be fully invested because this is the moment they've been waiting for. For them, this is not the time to sell. Now, this conviction creates its own kind of hidden risk. This large group of all-in investors represents a potential time bomb. Traditional economic models assume wealth effects are gradual, but if a deep crypto crash were to happen, it could trigger forced liquidations and a sudden spending cliff far steeper than those models predict. It's a critical point because our understanding of downside risk might be underestimated, as it doesn't account for this group's cliff-like behavior. This creates a paradox. How do you spend wealth you are determined to hold? For years, that question has been a major roadblock. As one industry leader put it, there have been countless horror stories of crypto millionaires with millions in assets, but unable to get a traditional mortgage. After all, they want to use a strategy that the ultra-wealthy have used for decades with stocks and real estate, often called buy, borrow, die. You buy an asset that grows in value, borrow against it for cash to live on, and then pass the asset to your heirs, often with significant tax benefits. These crypto investors don't want to sell and trigger a huge capital gains tax bill. They want to borrow against their holdings. That tide, however, may be turning. The FHFA director has issued a directive for Fannie Mae and Freddie Mac to consider cryptocurrency assets in their underwriting guidelines, a move that could unlock a wave of borrowing and spending that dwarfs what we have seen so far. This is a structural shift in the credit market. If crypto becomes widely accepted as collateral, it could create a powerful new channel for spending and credit growth. Looking ahead, this is a key focal point. We need to watch whether this directive translates into actual loan products and how quickly banks adopt these new underwriting standards. And this isn't just a US story. This growth of a parallel financial system is having global effects. For example, in economies with strict capital controls like China, cryptocurrencies, especially stablecoins like USDT, are increasingly used to move capital out of the country. Recent data shows China's capital and financial account deficit has been widening, indicating intensified capital flight. This trend challenges the effectiveness of capital controls and can put downward pressure on the yuan's exchange rate. The key takeaway is that the impacts of crypto wealth are just beginning to ripple through the global economy.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.